Hi everybody, this is Anchal Kaur from Vinod Kothari Consultants. As we head to the new year, we look back and reflect on the noteworthy events that happened during the year. As a professional tool, let's go back and reflect upon the significant regulatory changes that were brought in for financial sector entities, especially non-banking financial companies. This is a two-part video and this is part one of the series. Please note that this is a refreshing or a recap course, and in case you would like a detailed analysis, you may go through the articles attached to the PPT. It was quite an eventful year for NBFCs, with RBI keeping these entities on their toes. You could see the flavor of the amendments, and these were focused majorly towards consumer protection and information technology. So let's begin looking at each of these circulars one by one. Firstly, the scale-based regulations were introduced during 2021 and brought in a revised classification on NBFCs based on their asset size and significance. The SBR framework, though introduced in 2021, the provisions thereof were made applicable in a phased manner. Therefore, let's understand the requirements that became applicable in the calendar year 2023. We start with the disclosure circular that is applicable on all annual financial statements that were prepared for FY ended March 2023. The disclosure circular brought in a number of additional disclosure requirements that were varyingly applicable for NBFC BL, ML, as well as UL. This also included a detailed disclosure with respect to corporate governance, with respect to related parties, various lending exposures, sensitive sector exposures, etc., as well as grievances being faced by the NBFC. All in all, this must have already been incorporated or implemented by NBFCs this year. The next is on April 1, 2023, the compensation guidelines and the core financial services solutions provisions became applicable. The compensation guidelines provide guidelines with respect to compensation to the KMP of NBFCs, wherein they talk about the fixed and variable pay to be set by NBFCs, etc. The circular did not prescribe any thresholds. It required NBFCs to have a board-approved policy, a remuneration policy, listing down or outlining the compensation to be paid to such KMP. The CFSS was introduced akin to the core banking solutions that is already existent in case of banks. Next, on October 1, 2023, the compliance function became applicable. Also, please note the CFSS became applicable on April 1, 2023 for NBFC UL, while in case of NBFC ML, it is becoming effective in September 30, 2025. On October 1, 2023, the compliance function became applicable, which required NBFCs to have a chief compliance officer, to have a functioning and an effective compliance function in their organization, and also the requirement to undertake a compliance risk assessment. This is all that becomes applicable in 2023. Also, the SBR directions also were introduced in 2023, which consolidate the existing directions applicable to NBFC, NSIs, and SIs, along with the new circulars brought in by SBR framework. Next, we move on to the changes that were brought in case of Fair Practices Code or Fair Practices Lending. We start with the levy of penal charges, the circular or guidelines on penal charges. The RBI observed that NBFCs or financial entities are using penal charges as a cash cow and a means to generate revenue. Most of the times, these charges are hidden, exorbitant, or are charged in the nature of interest and are capitalized. And RBI pointed out that penal charges should not be used as a cash cow, but of their true intent of being a deterrent from the borrower defaulting. The circular brought in various requirements with respect to the penal charges not to be capitalized. Also, the penal charges should be reasonable. They should be proportionate to the kind of non-compliance that the borrower is undertaking. Also, these should be disclosed in your KFS, in your sanction letter, and there should be no hidden charges. The charges should be standardized across all loans and all borrowers and should be uniform across a loan category. Therefore, there should be no discrimination between individuals and non-individuals in case of penal charges for the same kind of default. Also, the NBFCs are required to formulate a board-approved policy for this respect. Please note that RBI is not prescribing a certain threshold, but that is left to the discretion of the NBFCs as per their policy. Now, when is this becoming applicable? In case of new loans, the penal charges circular has to be implemented for all new loans from January 1, 2024. But very recently, just 2 or 3 days back, the timeline has been extended to April 1, 2024. In case of existing loans, lenders have to implement the circular either by the next review date or within 6 months from the effective date of the circular. That is, in case of existing loans, the maximum time period will be June 30, 2024, or next review period, whichever is earlier. Next, the RBI brought in guidelines with respect to variation in the EMI pay due to reset of floating rate of interest. So this circular becomes relevant in case of loans qualifying the following conditions. One, that the loan is a floating rate, has a floating rate of interest. Secondly, the loan is is a personal loan. So though the floating rate of interest may be charged for various kinds of loans, but only personal loans are being covered here. So for example, a LAP loan for a business purpose would not be covered. A LAP loan to an individual would be. Housing finance loans would also be covered. Auto loans in case of for personal use would also be covered. And thirdly, these should be an EMI based loan. So loans with a bullet repayment would not be covered here. Now, what is the intent of the circular? What the RBI observed is that whenever there's a reset in the floating rate of interest, lenders would be using their own discretion to impact with respect to the impact on the loan. RBI instructed that this decision should lie with the borrower, and therefore the lender has to provide 6 options to the borrower whenever there's a reset in the floating rate of interest. What are the 6 options? One would be either enhancing the EMI or reducing the EMI. In case in case the interest is being increased, there would be an enhancement in the EMI. In case the interest is being reduced, there would be a reduction in the EMI. The second option would be either elongating the tenure or extending the tenure or reducing the tenure. Third option would be any combination of both of these options available. The fourth option is a prepayment. The borrower should be allowed to prepay a part of the loan or a major chunk of the loan in case there's a reset in the floating rate of interest. Next option would be full repayment. So the borrower should be allowed to foreclose the loan and repay the entire loan amount. And the last but most difficult option would be to switch to fixed rate of interest. Now, these options, also there's a 7th option. In case the borrower fails to respond to these 6 options, then a default option would be set by the lender itself. Now, this condition should be communicated and disclosed to the borrower. The lenders have to inform the existing borrowers by December 31st, 2023. To new borrowers, this should be made part of your repayment schedule as well. Any change in the charges should also be communicated to the borrower at the time of this loan sanction. A quarterly statement should also be presented to the borrowers, enumerating what is the principal and the interest that has been recovered, what is the EMI amount, the number of EMIs that have been left, and an annualized ROI. As and when there's a reset of the interest, the same also has to be communicated to the borrower. This will be applicable only in case of personal loans. The next is display of information on deposition under surface. So RBI, via its notification dated September 25, 2023, has required NBFCs as well as HFCs who have qualifying under a definition of secured creditors under SARFAESI to display certain information with respect to the procedure being undertaken under SARFAESI. This means that every lender will have to display information with respect to the borrowers whose secured assets are being taken into possession under SARFAESI Act. Therefore, only when I'm taking the SARFAESI route to enforce my security interest will I have to display this information. Using any other route or mode or recourse would not be covered here. The timeline is by March 25, 2024, that is in 3 months. And after that, a monthly updation will be required. Now, what kind of information do I have to present? The name of the borrower, the name of the guarantor, the outstanding amount that's left, the details of the security possessed, and the title holder of the security possessed. Next, we have a very important ruling by the Patna High Court on May 19, 2023, with respect to repossession of vehicles. So now this becomes significant for all our vehicle financing lenders. The Patna High Court ruled that any repossession being done outside of SARFAESI, repossession of vehicles specifically, being done outside of SARFAESI would be illegal. That means lenders have to follow the SARFAESI route to repossess any vehicle. Now, the intent behind this is usually, though repossession is a last resort being used by lenders, however, it is not a pleasant sight. Many a times, force is being used to repossess assets. Harsh means of recovery are being practiced. Therefore, the Patna High Court said that the SARFAESI procedure should be followed for repossessing of vehicles. Now, the question lies that SARFAESI as a recourse measure is not mandatory in nature. It is a facilitation for recovery. That means it is a non-judicial self-help recourse available to lenders. However, it cannot be made mandatory on lenders. Also, there are certain lenders that are outside of the ambit of a SARFAESI. For example, the definition of secured creditor under SARFAESI only covers NBFCs having an asset size of more than 100 crores and where the loan in question or the security interest in question is above 20 lakhs. In case of banks, the loan exposure or the security interest should be above 1 lakh. So this would only become relevant in case of NBFCs meeting this threshold. We need to understand that a borrower who has been defaulting continuously cannot sit on the pedestal of dignity and fairness. But also we need to understand that lenders are using harsh measures to recover. So maybe they can also look at better ways of recovery. Therefore, for repossession of vehicles, adequate notice should be given to the borrower before taking any possession of the vehicle. Also, the period of such loan should be mentioned in the loan agreement. The procedure for sale or auction should also be mentioned in the loan agreement. The procedure for taking possession will be mentioned in the loan agreement. A final chance should always be given to the borrower before the lender resorts to repossession. There are other also requirements being introduced. One question that arises is that whether would this only be applicable or relevant for entities in Bihar? Please note that the question here is with respect to fundamental element of lending and therefore which is being used by all NBFCs. So as such, the ruling should not be restricted to only Bihar, but lenders across the country should endeavor to implement the same. The next circular that was brought in by RBI in September 2023 was with respect to release of security documents. RBI observed that there is a disparity among various lenders in the manner of releasing property documents once the loan has been repaid and the loan account has been closed. Therefore, RBI had set a limit of 30 days from the final settlement to return or release all the original property documents to the borrowers. The requirement becomes very important because in case I delay have to pay a daily compensation of rupees 5,000 per day to the borrower. Also, I have to mention the timeline and the place of return of these documents in the loan sanction letters as well. In case I lose the documents, I will have to assist the borrower to recover these at the lender's cost itself. This has already become applicable from December 1, 2023 and is applicable on all loans secured either by movable or immovable property as well. This was with respect to fair practices lending. And now we move on to the prudential measures that were brought in by RBI. The first and the most important circular that definitely created a havoc in the industry was the regulatory measures towards consumer credit and bank credit to NBFCs. What RBI observed was a significant rise in personal unsecured loans. Considering the riskiness of these loans, the RBI required NBFCs to employ additional risk mitigation measures. These include, firstly, an increased risk weight in case of consumer credit. Before we move on to these requirements, let us first understand what would consumer credit actually cover. Now, consumer credit would mean all individual loans that are given for personal use. Now, this includes loans for consumer durables, credit card receivables, auto loans which are not for commercial use, loans given for consumption purposes, personal loans to professionals, and loans secured by gold jewelry, immovable property, etc. However, they exclude education loans, loans given for investment in financial assets, and loans given for creation of immovable assets. Therefore, any loans falling under these categories under the definition of consumer credit would have the circular applicable on them. However, the circular also has certain exemptions given for certain kinds of loans. For example, loans against gold jewelry, loans against immovable property, etc. Now, once the circular becomes applicable, what becomes important here? Firstly, the RBI has required NBFCs to employ increased risk weights in case of consumer credit. The existing risk weight in case of most loans in case of NBFCs is 100%. But now, once any loan attracts a definition of consumer credit, an increased risk weight of 125% will become applicable. This means that NBFCs would be required to get in more capital to cover these risk-weighted assets. Now, that's a huge impact on NBFCs who are significantly or majorly into unsecured personal loans. Please understand here, the rule of thumb is not based on the security, but on the usage or the end use of the loans. That is personal. Personal or consumption purposes. The timelines have been made effective immediately. Therefore, the increased risk weights become applicable from this quarter itself. And therefore, the next time you file an capital adequacy return with the RBI, you will have to employ the additional risk weights. The second requirement that has been brought into place is with respect to sectoral exposure on consumer credit. The RBI has required NBFCs to put in self-imposed caps on their unsecured lending as per their own policy. So these are self-imposed caps depending on the kind of business, on the kind of assets into focus, and diversification involved. These sectoral caps will be set by the board of directors and will be monitored on a continuous basis. The next circular that becomes applicable is the requirement with respect to default loss guarantee structures. Just to rewind a bit, we go on to understand that the RBI introduced the digital lending guidelines in 2021. The digital lending guidelines emphasize on the fact that first loss default guarantee is not allowed or is not permitted in India by RBI. It made it akin to synthetic securitization, which is barred in India by the securitization directions. Synthetic securitization or FLDG in any structure, be it physical or digital, is not permitted in India. However, RBI brought in a leeway in case of digital lending through this circular. The RBI allowed digital lenders to take in FLDG of up to 5% from their lending service providers or by through an other entity. Now, what is default loss guarantee defined here? The default loss guarantee means a contractual arrangement called by whatever name between the regulated entity and an entity meeting the criteria given under the direction guidelines, where the latter guarantees to compensate the RE any loss due to default up to a certain percentage of the loan portfolio specified upfront. Now, when I talk about this being called by whatever name, so implicit guarantees are also covered. That means any arrangement in the form of a guarantee, in the form of an FLDG, would also be covered here, even though it's not explicitly called as FLDG. Now, the RBI has recognized three forms of guarantee in this case. One is cash deposits with the lender. The second is fixed deposit maintained with a bank with a lien marked in favor of the lender, and third is bank guarantee in favor of the regulated entity. Now, who can be the guarantor here? The LSP or any regulated entity can be the guarantor. However, these have to be in the form of a company registered under the Companies Act. There has to be a digital lending arrangement explicitly talking about the DLG cover, the extent and form of the FLDG, and the timeline for invocation. The tenure can go up to the longest tenure of the loan in the loan portfolio. The limit on the DLG cover would be up to 5% of the amount of loan portfolio. Now, what is required by NBFCs here? Firstly, I need to have a board-approved policy in place covering the nitty-gritties around FLDG. I need to ensure my classification of NP as per the extent norms, because even though the RBI says that even though I invoke a FLDG, the NPA classification would not be shifted. There are other requirements also with respect to DLG that have been brought in by the circular. The next is with respect to the compromise settlement and technical write-off circular. 4 years back, the RBI had already introduced the prudential framework for resolution of stressed assets in 2019, covering any resolution or any arrangement giving a relief to the borrower who has been defaulting. Thus, the compromise settlement and technical write-off circular is an addition to this PFRSA and has intended to streamline the process for providing a resolution to the borrower. Now, what the lenders have to do here? The lenders will have to put in place a board-approved policy talking about the compromise settlement and technical write-offs. They need to specify the minimum aging of the loans, the collateral depreciation, and also the maximum sacrifice or the maximum sacrifice that they are ready to bear. One important change that came to the circular is that the Prudential Framework 2019 did not allow for any compromise settlement in case of fraud accounts. However, or fraud or willful defaulted accounts. However, the RBI through the circular has allowed a compromise or a settlement with fraud accounts as well. Once I have entered into a compromise settlement with a borrower, will have to have a cooling off period, and I cannot take any exposure on such borrowers for a minimum period of 12 months. In case of technical write-offs, the same has not been specified. There are other requirements also coming through the circular. The next is with respect to lending and investment strategies. Firstly, the government of India, the central government, introduced the PMvishwak scheme, which is a scheme introduced in the interest or promotion of artisans and craftsmen. So, with respect to, if you look at what is relevant for lenders here, is that such borrowers are eligible to get a credit support from the government for any loans being taken from NBFCs, microfinance institutions, etc. Now, here, what is happening is that the eligible borrower can go and take a loan, enterprise development loan, up to rupees 3 lakh from the NBFC. It will be an unsecured loan without any collateral, Also, the eligible borrowers can avail a loan at a concessional rate of 5%, and the government will be providing a subvention of 8% to lenders granting such loans. Another important point would be that firstly, that the loan will be unsecured in nature. No prepayment penalty can be charged in case a borrower prepays within 6 months of the loan disbursement. The loan will be repaid in monthly installments, and credit information will be checked. However, it cannot be a criteria to decline a loan. Therefore, lenders can extend such loans to borrowers who are registered under the scheme. The RBI introduced the framework on green deposits in 2023, and which will become effective from 1st June 2023. This is majorly with the need of moving to sustainability and promoting sustainable finance. This allows banks and deposit-taking NBFCs and HFCs to raise green deposits from 1st June 2023. Now, these green deposits will be deployed towards green finance. Now, what would be green finance? A taxonomy will be developed later. However, a list of eligible green activities has been given, which is very similar, or which is in line with the SEBI's guidelines with respect to green bonds. There are certain, in case any lender is going to raise such deposits, there are certain guidelines in place with respect to having a policy on green deposits, having a financing framework for allocation of proceeds from these green deposits, to undertake an impact assessment of the proceeds, a third-party verification for allocation of funds, etc. The next and a very recent circular was brought in by RBI on December 19th, 2023, which has become effective immediately. This is with respect to regulated entities' investments in AIFs. If you look at the circular and the language of the circular, it has a very huge impact on the financial industry as well as on the AIF industry. Now, what does the circular do is that it prohibits any regulated entity from investing in any AIF who has from investing in any AIF who has made investment in a debtor company of the RE. This means that if any lender or if any NBFC has made any investment or has given any loan to a borrower entity, then and in case an AIF is investing in such company, then the RE cannot invest in such AIF. This was majorly done to curb the evergreening practices of NBFCs from routing funds through AIFs for evergreening of their loans. Now, this bar, as I mentioned, is effective immediately. And in case there are any existing investments of lenders or of NBFCs in these AIFs, the same will have to be exited within 30 days. Now, this raises a lot of difficulties, considering that certain NBFCs would have invested from a purely investment point of view. The circular should have covered AIFs that were related parties of these NBFCs to draw clear nexus or a relation between the two entities. Also, usually AIFs are close-ended funds, and therefore it would be very difficult to exit from these investments. Also, considering that the AIF would have to buy back the units, the AIFs would also be forced to raise additional funding through various means. And considering that some AIFs cannot even raise loans, this would also raise a huge concern on the AIF industry. Next, we move on to the last that we are covering today is with respect to amendments in the KYC directions. So the KYC directions went through 3 different kinds of changes during the entire year. One in April, one in May, and one in October. So the April circular firstly requires entities of a financial group to have a group AML policy. That means in case in my group, I have more than one regulated entity, under the PMLA Act. So the PMLA Act covers various regulated entities such as financial entities as NBFCs, HFCs, banks. Also, SEBI intermediaries are covered, and other designated businesses are also covered. So in case my group has multiple regulated entities, it will have to have a group-wide policy in place. Now, what would this group-wide policy do is that it will look at the borrower holistically. That means if one entity identifies the account as suspicious or has suspicion on the activities of an account, it will have to send alerts to its group so that the group also does not transact with such an account. Secondly, the threshold for beneficial ownership was also increased. So where an NBFC is extending loans to non-individuals and it has to do a CDD of its beneficial owners, it will have to look at all beneficial owners which have a controlling interest of more than 10%. The earlier threshold for companies was 25%, which was increased to 10%, which was reduced to 10%. In case of LLPs, the earlier threshold was 25, which was brought down to 15, and then it was brought down to 10% as well. Therefore, I have to take additional documentation in case my borrowers are companies, partnership firms, trust for the purpose of doing a customer due diligence. This includes details of all partners, details of shareholders, etc. The last and most important in the era of digital lending would be allowing a non-face-to-face KYC through an enhanced DD. What RBI observed is that the industry or the world at large is moving towards digitization, and so is lending. Therefore, it is not possible to have a face-to-face interaction or a physical meet with the borrower each time. There are various lenders who are transacting through digital platforms, and therefore a physical KYC would not be possible. Therefore, it has allowed a non-face-to-face KYC to be conducted. That means I do it either through DigiLocker, I do it through CKYCR, or I collect documents without physically meeting the customer, or even doing a video-based KYC. In these cases, I have to have enhanced due diligence measures in place to mitigate the heightened AML risk involved. For example, this would require me to do a contact point address verification, to have the first transaction from a KYC compliant bank account, and only to transact through the mobile number registered with the lender. The next is with respect to amendments in October that were brought in in the KYC directions. One was with respect to the principal officer being at a management level position. That means in case I have, what would be the meaning of management level has not been defined. It will be taken from the meaning of senior management under the Companies Act. Apart from that, the requirement of group AML policy was clarified to only be applicable in case of regulated entities in the group. There was a lot of discussion and confusion around what kind of, will it also extend to non-regulated entities in a group, which is clarified by RBI under the circular. Next was that in case that the regulated entities, NBFC, is not able to undertake a full CDD as per their policy, they will have to, by default, file an STR with the FIU. There are other requirements also which have been brought in by the circular. And all in all, this is what we would be covering today. Thank you, everybody, who stay with us, and a very, very advanced Happy New Year. In case you have any questions, you can always reach out to us in the email ID, as well as drop a comment to this video. Thank you so much. Bye-bye.